What is the January 2025 International Monetary Fund IMF World Economic Outlook update, published twice a year, telling us about the global economy and what does it mean? The update, themed Global Growth Divergent and Uncertain, shows minimal change to global economic growth projection at 3.3% for 2025. Hello, this is Bode Oshosami, and welcome to another episode of Global Business Insights, where we take a closer look at some of the topical global business themes. The International Monetary Fund boss, Kristalina Georgieva, recently commented that the world was seeing steady global economic growth and continuing disinflation amid high uncertainty, waiting to see what the new United States administration is going to do. In its latest risk report, the World Economic Forum sees state-based armed conflict as the most significant area of global risk. Misinformation and disinformation and societal polarization also remain top current risks. A world of deepening political divisions, rising protectionism, and weakening trust implies even more fragmentation within societies and among countries. But one cannot miss the transition. All growth drivers like real estate and commodities in resource economies are increasingly outperformed by the new digital and efficient technologies-driven economy. Pierre-Olivier Gourinchas, the IMF Chief Economist, in his update today, saw little or no change but focuses on divergence between faster-growing economies like the US and others like Europe amid much uncertainty. Let's hear a clip from his presser.
In our latest projections, global growth remains steady at 3.3% this year and next, broadly aligned with world potential growth. Inflation is declining to 4.2% this year and 3.5% next year in a return to central bank targets. This means that the very large global disruptions that started with the pandemic, the war in Ukraine, and triggered the largest inflation surge in 40 years are behind us. This is the end of a cycle and the beginning of a new one. While the global outlook is broadly unchanged from October, divergences are widening. Among advanced economies, the United States is stronger than previously projected, expected to grow at 2.7% this year. By contrast, growth in the euro area is revised downwards and will increase only modestly to 1% in 2025, reflecting low consumer confidence and the persistence of high energy prices, especially relative to the United States. Elevated trade policy uncertainty will contribute to anemic demand in many countries, including China, where we project 4.6% growth this year. Some of the divergence is structural. For instance, the US experienced persistently stronger productivity growth than Europe, especially in the technology sector, linked to a favorable business environment and deeper capital markets. Among emerging economies, potential growth has decreased for China, in line with secular and demographic trends, but it has increased in other emerging markets, and the two are now comparable. Turning to the risks, economic policy uncertainty is elevated, with likely policy shifts from many newly elected governments in 2024. In the near term, risks could exacerbate divergences between countries. The euro area could slow down more than anticipated due to weak momentum in manufacturing and fiscal vulnerabilities in some countries. For China, the risks are also to the downside. The economy is at risk of a debt deflation trap, and the decline in Chinese government bond yields shows rising investor concern. Both for the euro area and China, this could lower activity and inflation. For the US, many of the uncertainties originate with potential policy shifts under the new US administration. While these are hard to quantify precisely at this stage, we would categorize them as follows. First, there are demand-stimulating risks, such as a further fiscal stimulus or a confidence boom fueled by expected deregulation efforts. These would increase output and inflation in the near term. There are also supply-constraining risks, such as higher tariffs or curbs on migration. These would weigh on output, but also add to price pressures. The combined effect on output in the near term is uncertain, but likely to the upside in our assessment. Any combination of these policies, on the other hand, is likely to add to price pressures in the US. Higher inflation would prevent the Federal Reserve from cutting interest rates as initially planned. These policies will also likely strengthen the dollar and tighten financial conditions elsewhere, especially for emerging market and developing economies. In the medium term, the risks are more uniformly to the downside. Curbs on migration and protectionist policies will weigh on potential output. The initial positive effect of a fiscal expansion will wane, and the associated increase in public debt could lead to fiscal vulnerabilities further down the road. The increase in U.S. long-term yields, despite the Federal Reserve easing, reflects some market nervousness about future fiscal policies. Deregulation could boost output by removing red tape and spurring innovation, but it could also increase financial vulnerabilities. Another risk is that renewed inflation pressures so soon after the recent episode could de-anchor inflation expectations as people and businesses have become much more vigilant. Indeed, we see that near-term inflation expectations have increased above central bank targets. Turning to policies, given this environment, central banks should remain vigilant and be ready to act forcefully if inflation were to break out again, while also monitoring carefully the buildup in financial risks. Second, fiscal buffers need to be restored now, and countries need to do so in a way that preserves growth. As history teaches us, delaying needed adjustments in a low-growth, high-interest rates environment can trigger market loss of confidence that would further add to fiscal pressures. In addition, countries should continue to seek ways to improve growth by focusing their efforts on ambitious structural reforms that will help better allocate resources, increase government revenues, foster innovation and competition. On that front, it is also important to preserve and improve our multilateral institutions to help unlock a richer, more resilient, and sustainable global economy. Thank you.
For economists, uncertainty always strikes a downside tone, and that was evident in the speech. In short, it came across as let's wait and see scenario, not underplaying the uncertainty and risks, with global growth just slightly upgraded, still below the historical 2000 to 2019 average of 3.7%. US growth was revised up by 0.5% at 2.7%, while China is expected to see modest recovery. Global headline inflation declining to 4.2% in 2025 and to 3.5% in 2026, seen also as converging back to target earlier in advanced economies than in emerging market and developing economies. U.S. fiscal trade policy could act in opposite direction to output growth and risks, impacting inflation and the pivot to easing monetary policy. This has downside impact on emerging markets and developing economies, especially the heavy dollar borrowers, who will have to contend with both strong dollar and higher rates amid the elevated policy uncertainty. IMF advocates rebuilding buffers and lifting medium-term growth prospects through stepped-up structural reforms as well as stronger multilateral rules and cooperation. The update was limited with no revisions to the Africa forecasts, but if we do get central banks tightening again as inflation picks up, that will erode trust with implications for emerging markets. Let's listen again to Pierre reiterating risks to emerging and developing economies.
Now, the danger is some of that capital may have been eroded, if you want, that credibility capital may have been eroded. And if we were to have a new sequence of increase in price pressures, which again, as I explained, is not part of our baseline, it's under some of the risks that would be associated with maybe some expansionary policies in some part of the world or some supply constraining policies, then that capital may be eroded, and as a result, households, people, businesses may be very, very cautious and very reactive in adjusting their prices and their inflation expectations going forward. If you have a combination of policies that leads to stronger activity and a resurgence of price pressures in the US and leads the Federal Reserve and maybe other central banks to delay their easing cycle, then that will attract foreign capital, that will strengthen the dollar, and that will, in doing so, that will put pressure on the rest of the world. Many countries, especially emerging market economies, but we see that elsewhere, have imported goods that are priced or invoiced in dollars. A stronger dollar means higher prices for these goods. It means higher domestic inflation pressures.
year in 2024, with fourth quarter GDP beating expectations with a 5.4% growth. US retail sales was up by 0.4%, lower than November's 0.8% increase and below market expectations of a 0.6% rise. Still in the US, citizens filing new applications for unemployment insurance rose to 217,000 for the week ending January 10, missing initial estimates and above the previous week's print of 203,000. BP said it was cutting 4,700 jobs. Chief Executive Murray Auchincloss is targeting costs, also reducing the number of contractors it uses by 3,000 this year. The outlook for crude oil markets is for more volatility as demand broadly struggles amid ample supply and geopolitical flux. European stocks are boosted by reports that mining giants are talking of a mega merger, as Rio Tinto and Glencore are said to be holding talks to create a behemoth to rival long-standing industry titan BHP Group. Yesterday, we saw US stocks closing down amid all the uncertainty associated with the White House transition. Chip manufacturer Taiwan Semiconductor Manufacturing announced a strong December quarter thanks to surging demand for high-tech artificial intelligence hardware. We continue to get blowout bank earnings in the US as we get the releases on better than expected investment banking and interest income. Morgan Stanley turned in $3.7 billion of profit in Q4, up 147% from a year earlier. Bank of America said its fourth quarter profit more than doubled to $6.67 billion or 82 cents per share from a year earlier. The pound sterling fell further as UK retail sales contracted by 0.3% month-on-month. Economists had expected a faster pace of 0.4% than also higher than 0.2% growth in November. The pound already gave up earlier gains as UK November GDP disappointed, up 0.1% month-on-month versus 0.2% expected. Both manufacturing and industrial production data contracted in November on a monthly basis as well as on an annual basis. Month-on-month industrial and manufacturing production was down 0.4% and 0.3% respectively. Hopes of rate cuts were, however, helped by latest lower than expected inflation data for December. Analysts now see over 80% chance that the Bank of England reduces interest rates by 25 basis points to 4.5% at its next February policy meeting. TikTok's fortunes may be taking a positive turn as the growing number of US officials said it may have more time to sell the app and stop it from being banned ahead of President-elect Donald Trump's return to the White House next week. Still on data, on Wednesday we got Nigeria's December inflation rate hitting near 30-year high of 34.8%, up from 34.6% in the prior month. Food inflation eased slightly to 39.8%, while on a monthly basis, the CPI index was up by 2.4% in December, slowing from a 2.6% surge in November. The Statistics Office says changes as a result of rebasing the consumer price index will come into effect at the end of January. Analysts will be waiting for the rebasing to settle before concluding on any signals from the data. Asia Pacific markets traded mostly mixed as we got positive data from China. 2024 GDP growth met expectations. December retail sales rose 3.7% from a year earlier, more than expected, and indeed industrial output also expanded more than expected. Well, that's all that we have on this episode of Global Business Insights. Thanks for watching, and please share and subscribe to follow the channel.